Good morning, dear learners, and welcome to the MOOC on Indian economy, policy, and environment. And we are in Module 11, the external sector, and this is the first unit of the module, and it's on India's foreign trade. So, India's foreign trade has undergone significant transformation since gaining independence in 1947. The evolution can be broadly divided into two distinct phases: the pre-reform period, 1947 to 91, and the post-reform period, that is 1991 till present. The pre-reform era was characterized by inward-looking economic policies, imposed substitution, industrialization, and stringent trade controls. These things we have already discussed in the previous units as well. So, in contrast, the post-reform period saw a paradigm shift towards liberalization, globalization, and export-oriented growth. So, in this unit, we shall examine the structural and directional changes in India's foreign trade, comparing the pre- and post-reform periods. We shall also try to analyze the case of India's foreign trade in terms of the recent changes in the major foreign trade indices, namely relating to exports, imports, gross terms of trade, net terms of trade, and income terms of trade. And then we shall try to analyze the structure and direction of India's foreign trade. In the next, we shall analyze India's balance of payment position. And finally, we shall look into the future prospects and challenges in the phases in international trade arena. So let us begin with the trends of trade indices in the recent years. As already mentioned, in this section we shall try to analyze the trends of India's trade indices in the recent years as has been shown in Table 1. So in Table 1, the trade indices presented in Table 1 provides a comprehensive overview of the foreign trade performances from the fiscal year 2013-14 to 2013-14. So roughly around a decade. So following broad trends may be observed from this table. First, the export index shows a consistent upward trend, increasing from 112 in 2013-14 to 160 in 2022-24. This indicates strong growth in export performances, particularly notable in the years of 2018-19 and 2020-21. The import index also demonstrates an upward trajectory, rising from 108 to a projected 140 over the same period. The peak was observed in 2022-23 at 157, reflecting increased import activity in the economy. The gross terms of trade index fluctuated, peaking at 116 in 2020-21 and projected to reach 201 in 2023-24. This improvement suggests that the country is obtaining more value from its exports relative to imports. The net terms of trade index showed a slight decline from 68 in 2013-14 to a projected 73 in 2023-24, indicating challenges in achieving favorable trade conditions despite improvements in purchasing power. The income terms of trade exhibited a significant increases from 144 to a projected 230, highlighting enhancing purchasing power from exports relative to import cost. So this trend reflects improved economic conditions and greater efficiency in trade. Thus, overall, the data indicates a positive trend in foreign trade, with exports growing at a faster rate than imports, leading to improved terms of trade. The increasing income terms of trade is particularly encouraging, suggesting that the economy is becoming more competitive in the global market. Continued focus on enhancing export quality and managing import costs will be essential for sustaining the positive trajectory in the future. Now let us look into the structure of India's foreign trade. So in this section, we shall analyze the trend of exports, imports, and trade balances in both value and volume terms. Now looking at trends of export, imports, and trade balances in value terms, we will see that since independence, India's trade volume has increased considerably, particularly in the post-reform period after 1991. This can be seen from the table shown in Table 2. The data of Table 2 shows that for exports and imports and trade balances provide valuable insights into the evolution of the country's trade dynamics over several decades since independence and the recent years since 2020-21. So from this data we see that in the fiscal year 1949-50, exports were valued at 485 crores, while imports stood at 617 crore, resulting in a trade deficit of 132 crores. This early period reflects the challenges faced by post-independence India, characterized by limited export capabilities and a reliance on imports, basically on food items. The following year, 1950-51, saw a slight increase in exports to 606 crore and a marginal rise in imports to 608 crores, leading to a negligible trade deficit of 2 crores. This stabilization in trade marked the beginning of a recovery from the immediate post-independence economic challenges, though it did not last long. So by 1960-61, exports had grown to 642 crore, while imports surged to 1,122 crore, resulting in a significant trade deficit of 480 crores. The sharp increase in imports during this period indicates growing demand for foreign goods, likely driven by countries' industrialization efforts. And in 1970-71, we will see that exports rose 1,535 crore and imports increased to 1,634 crore, resulting in a smaller trade deficit of 99 crore. This period reflects a more balanced trade scenario as the country began to enhance its export capabilities. The decade of the 1980s marked a significant increase in both exports and imports. In 1980-81, export reached 6,711 crore, while imports soared to 12,549 crore, leading to a substantial trade deficit of 5,838 crores. This decade was characterized by economic liberalization and increased consumer demand, which contributed to the growth in trade. And by 1991, exports further increased to 32,553 crore and imports rose to over 43,000 crore, resulting in a trade deficit of more than 10,000 crores. So the economic reforms initiated in 1991 began to reshape the trade landscapes, leading to increased export potential. In the early 2000s, the trade dynamics continued to expand. In 2000-2001, exports were valued at 2,01,356 crore, while imports were 2,28,307 crore, resulting in a trade deficit of 26,951 crore. This period saw significant growth driven by globalization and increased integration of the Indian economy into the world economy. So by 2010-11, we will see that exports surged to 11,36,964 crore and imports reached 16,83,467 crore, leading to a trade deficit of 5,46,503 crore. This growth reflects the impact of the global economic environment on trade dynamics, with substantial increase in both exports and imports. Again, the year of 2020-21 marked a notable shift due to the COVID-19 pandemic, with exports slightly decreasing to 21,59,043 crore and imports falling to 29,15,958 crore, resulting in a trade deficit of 7,56,915 crore. The pandemic significantly impacted global trade, leading to fluctuation in both exports and imports. However, in 2021 and 22, exports rebounded to 31,47,021 crore and imports increased to 45,72,770 crore, resulting in a trade deficit of 14,25,753 crores. So this recovery from the pandemic was evident with a strong resurgence in trade activity. In 2020-23, exports further increased to 36,21,550 crore, while imports rose to 57,49,801 crore, leading to a trade deficit of more than 21 lakhs crore. So this year reflects ongoing economic recovery and increased demand for imports. So the trade dynamics suggests a continued trend of increasing imports relative to exports. Now let us view the rates of changes in export and imports. That is, let us view the change in trades in volume terms. The rate of change in exports and imports over these selected years reveals significant trends in volume terms. From 1949-50 to 1950-51, the export growth rate was approximately 24.9%, while imports grew by 1.5%, indicating a stabilization phase post-independence. Between 1960-61 and 1970-71, exports grew by about 139.5%, while imports increased by 45.5%, reflecting the impact of industrialization and economic policies aimed at boosting exports. The decade from 1980-81 to 1990-91 saw exports grew by approximately 384.5%, while imports increased by 233.5%, driven by economic liberalization and increased consumer demand. Now, from 1990 1991 to 2001, exports grew about 519.5%, while imports increased by 128.5%, highlighting the crucial role of economic reform initiated in 1991 in enhancing export capabilities of the country. The period from 2001 to 2010-11 saw exports grow by approximately 465.5%, while imports increased by 138.1%, reflecting the impact of globalization and increased integration into the global economy. The years of 2020-21 to 2021-22 showed a rebound in exports with a growth rate of approximately 46%, while imports increased by 56.5%, indicating a recovery phase post-pandemic. Thus, in this section, we have seen that the trend of exports and imports over these selected years highlights the evolving trade landscape in the country. The significant fluctuation in trade balances and the varying rates of change in exports and imports reflect the impact of economic policies, global market conditions, and domestic demand on the country's foreign trade dynamics. The data underscores the importance of strategic initiatives to enhance export competitiveness while managing import growth effectively. Now let us consider composition of India's foreign trade. In this section, we shall analyze composition of India's foreign trade, particularly in terms of imports and exports. Let us begin with imports. Data shown in Table 3 indicates that India's import composition has undergone significant changes from the pre-reform period 1960-61 to 1990-91, as we have seen in the table, to the post-reform period of 1991 onwards and in the recent years as shown. So during the pre-reform era, India operated under a closed economy model characterized by heavy regulation and protectionist policies. The primary strategy was import substitutions aimed at promoting domestic industries and reducing dependency on foreign goods. As a result, the composition of imports during this time was heavily skewed towards capital goods, which included machinery and equipment necessary for industrialization. Additionally, raw materials were a crucial component of imports, particularly for sectors like textiles and chemicals, which required these inputs to support domestic production. Consumer goods were limited in their import volume due to high tariffs and stringent restrictions, reflecting the government's focus on self-sufficiency. Furthermore, food and agricultural products were imported to ensure food security, especially during periods of drought or poor agricultural output. In contrast, the post-reform period made a significant shift in India's import landscapes initiated by the liberalization policies in 1991. These reforms led to a more open economy characterized by reduced tariffs and non-tariff barriers, which encouraged a surge in imports. The composition of imports evolved to include not only capital goods but also a substantial increase in intermediate goods, reflecting India's integration into global supply chains. The rise in imports of consumer goods was particularly notable, with significant volumes of electronics, automobiles, and luxury items entering the Indian market. Additionally, energy products, especially crude oil and natural gas, became a major component of imports due to the rising energy demands of a growing economy. The post-reform period also saw an increase in imports of pharmaceuticals and chemicals as India sought to enhance its domestic production capabilities by sourcing raw materials from abroad. Comparatively, the dependency on imports shifted significantly between the two periods. In the pre-reform era, there was a high reliance on capital goods and raw materials with limited diversification in imports sources due to stringent regulations. However, the post-reform period witnessed a broader import base with a mix of capital, intermediate, and consumer goods. This diversification was facilitated by greater trade with countries such as China, the USA, and the European Union, reflecting India's deeper integration into the global economy. The policy changes not only foster competitiveness and innovation within domestic industries, but also transform the overall structure of imports, making it more balanced and dynamic. Thus, we have seen that India's import composition reveals a significant transformation from a heavily regulated and limited structure in the pre-reform period to a more diversified and dynamic landscapes in the post-reform era. So this shift underscores the broader economic changes and the impact of globalization on India's trade policies, highlighting the evolution of the country's import needs in response to changing domestic and global economic conditions. Now, Let us look at the composition of India's exports. Table 4 in the above shows India's export composition has experienced significant transformation from the pre-reform period to the post-reform period. It can be seen that during the pre-reform era, India's export strategy was heavily influenced by a closed economy model characterized by protectionist policies and focus on import substitution, as we have already discussed. The primary export during this period were primarily raw materials and primary commodities. Agricultural products, including tea, coffee, and spices, constituted a substantial portion of exports, reflecting India's agrarian economy nature. And additionally, textiles and garments were significant contributors, as India had a long-standing tradition in this sector. However, the overall export base was narrow, and the country faced challenges in diversifying its export portfolio due to restrictive trade policies and limited access to international markets. The pre-reform period also saw a significant reliance on a few key markets, with exports primarily directed towards countries in the developing world and a limited presence in the advanced economies. The lack of competitiveness in manufacturing and technology-intensive goods further constrained India's export potential. As a result, the overall growth of exports was modest, and the country struggled to achieve a favorable balance of trade. In contrast, the post-reform period marked a dramatic shift in India's export landscape initiated by the liberalization policies of 1991. This reform aimed to open up the economy, reduce trade barriers, and enhance global competitiveness. As a result, the composition of exports diversified significantly. While traditional sectors like agriculture and textiles continued to play a role, there was a notable increase in the export of manufactured goods, particularly in sectors such as engineering, pharmaceuticals, and information technology. The rise of the IT and software services industry became a hallmark of India's export growth, positioning the country as a global player in this sector. Furthermore, the post-reform period saw a substantial increase in exports to developed economies, including the United States and the European Union, reflecting India's integration into the global market. The diversification of export markets and products contributed to a more balanced export structure, reducing dependency on a limited range of commodities. The growth of value-added products and technology-intensive goods became a significant driver of export performance, showcasing India's evolving industrial capabilities. Thus, this analysis of India's export composition reveals a profound transformation from a narrow commodity-focused structure in the pre-reform period to a more diversified and dynamic export landscape in the post-reform era. This shift highlights the impact of economic liberalization and globalization on India's trade policies, enabling the country to enhance its competitiveness and expand its presence in international markets. The evolution of India's exports not only reflects changes in domestic production capabilities, but also underscores the importance of strategic policy reforms in fostering economic growth and development. Now let us move to a discussion on the direction of India's foreign trade. The dynamics of international trade have evolved significantly over the years, as we have already seen, particularly in the context of India's trade relations with various regions such as the OECD, OPEC, Eastern Europe, developing nations, and others. So in Table 5, we can see the changing pattern of both exports and imports across these regions, highlighting key trends and shifts. The analysis of India's import direction highlights significant changes in trade relations over the period from 1960-61 to 2021-22, as seen in Table 5. So India's trading partners are classified into 5 groups: OECD, OPEC, Eastern Europe, developing nations, and others. A notable decline in the importance of OECD nations is evident. Their share in India's import expenditure plummeted from 78% in 1960-61 to just 26.7% in 2021-22. Conversely, India's reliance on oil exporting countries, OPEC countries, has increased substantially, with their share rising from 4.6% in 1960-61 to 24.6% in 2021-22, largely due to India's need for crude oil. Relations with Eastern Europe have seen fluctuations, with their import share growing from 3.4% in 1960-61 to 10.3% in 1981 and subsequently declining to 2.3% in 2021-22 due to the collapse of the communist regimes, particularly the USSR. The most significant increase in import shares comes from developing nations. especially in Asia, which accounted for 46.3% of India's import expenditure in the recent years like 2021-22. Now, while examining specific countries, we can see that the UK held a 28.8%, 20.8% share of India's imports in 1950-51, and with the USA at 80.3%, together representing 39.1%, reflecting India's colonial past. However, within a decade, the trading landscapes began to shift, with emerging partners like the West Germany, Canada, and the USSR altering the positions of the UK and USA, resulting in the USA overtaking the UK as a primary trading partner. This evolution underscores the dynamic nature of India's trade relationship and its shifting economic dependence over time. Now, during this planning period, India's primary sources of imports has been the USA, largely due to the significant import of capital goods, intermediate goods, and food grains under the PL 480 agreement we have already discussed in the earlier units as well. So, as India expanded its trading relations with other countries like Japan, West Germany, and the USSR, its dependence on the UK markedly reduced. The UK share in Indian imports dropped from 19.4% in 1960-61 to just 1.1% by 2021-22. Conversely, Japan's share rose from 1.5% in 1950-51 to 7.5% in 1991, but then fell to 2.2% in 2021-22. Another notable development was the strengthening of the trading ties with socialist nations, particularly the USSR. In 1950-51, imports from USSR were negligible, rising to a mere 16 crore by 1960-61. However, they increased significantly due to bilateral trade agreements. By 1984-85, the USSR held a 10.4% share, surpassing the USA. And in 1985-86, the USA regained the top position, followed by Japan and the USSR. By 1990-91, the USA reclaimed first place with 12.1% share, while unified Germany held 8% and Japan remained third at 7.5%. The UK's and the Saudi Arabia share were both 6.7%, while Belgium and the USSR shares had shares of 6.3% and 5.9% respectively. Following the disintegration of the USSR, India's import dynamics shifted significantly. By 2021-22, China emerged as the leading source of imports with 15.4%, followed by the UAE 7.3%, USA 7.1%, and Saudi Arabia 5%. Other notable import sources for India include Iraq, Switzerland, Hong Kong, Singapore, Indonesia, and South Korea. Now let us see the direction of India's exports. India's export landscape has transformed due to economic reforms, globalization, and changing demand patterns. OECD countries remain vital for India's exports, with significant growth in high-value goods like pharmaceuticals, IT services, and engineering products. The surge of demand for IT services aligns with global digitalization trend. Conversely, exports to OPEC countries primarily focused on crude oil have gradually diversified into textiles and agricultural products, showcasing India's aim to strengthen trade ties beyond energy sector. Additionally, Eastern Europe is emerging as a key market, particularly in machinery and automotive components, driven by industrialization and technological needs. Meanwhile, exports to developing nations are rising as competitive prices and the demand for affordable goods in sectors like consumer electronics and agriculture are becoming prominent. From Table 5, we can also see the substantial role of OECD countries in India's export landscape, where their share decreased from 66.1% in 1960-61 to 25.8% in 2021-22. In 2021-22, the EU's contribution was 15.4% of total export earnings. Conversely, OPEC's share rose from 4.1% in 1960-61 to 12.0% in 2021-22. Exports to Eastern Europe, particularly the USSR, witnessed significant growth, climbing from 7% in 1960-61 to 22.1% in 1980-81. However, recent political upheavals in Eastern Europe and the USSR disintegration caused a decline, reducing its share to just 1.1% in 2021-22. Developing nations like Africa, Asia, and Latin America accounted for 43.7% of India's export in 2021-22. with Asian countries specifically contributing 31%. And in terms of country-wise exports, the UK held a dominant share of 23.3% in 1950-51, but fell to 11.1% in 1970-71 and further down to 2.8% in 2019-20. The USA also saw a decline in its share from 19.3% in 1950-51 to 16% in 1960-61. It should also be noted that in the early years of independence, India was heavily reliant on UK and USA, with their combined share at 42.6% in 1950-51 and 44.8% in 1960-61. Post 1960-61, trade relations with both capitalist and socialist nations expanded, leading to a surge in USSR's passages, which grew significantly from 11 crore in 1950-51 and increased to 210 crores in 1970-71 and further increased to 2006 crores in 1985-86. In 1991, USSR, with a share of 16.1% of India's exports earnings, occupied the first position, with USA, with a share of 14.7%, occupying the second position. Japan, with a 9.3% share, occupied the third position. The position changed markedly thereafter due to disintegration of the USSR. As is clear from Table 5, exports to Russia accounted for only 0.8% of export earnings in 2021-22. In this year, USA, with a share of 18%, occupied the top place. It was followed by UAE, 6.6%, China, 5%, Bangladesh, 3.8%, Netherlands, 3%, Singapore, 2.64%, Hong Kong, 2.6%, UK, 2.5%, Belgium, 2.4%, and Germany, 2.3%. So now let us look into the issues of balance of payment situations in pre- and post-reform periods. India's balance of payment experienced significant changes around the time of economic reforms initiated in 1991, which included the significant measures of devaluation of the rupee. Prior to this, India faced a persistent BOP crisis characterized by high trade deficits and dwindling foreign exchange reserves. It is significant to note here that in 1991, balance of payment crisis in India was a significant economic emergency driven by fiscal mismanagement, high current account deficits, and excessive external debt. Persistently high fiscal deficits exceeding 8% of GDP stem from inefficient public spending and loss-making enterprises largely financed through borrowing. Concurrently, the current account deficit, widened to about 3% of GDP, exacerbated by increasing oil import costs post-Gulf War and the sluggish export growth. Foreign exchange reserves fell dramatically to only 1.2 billion, leading to a loss of international confidence in the country. To avert default, India placed gold and collateral for an IMF loan, prompting major economic reforms that liberalized its economy and initiated transformative growth. We shall discuss this issue in some detail in the next module during our discussion on economic reforms in India. Now, in the post-reform period, the BOP showed improvement, influenced by various reforms aimed at liberalizing the economy and encouraging foreign investment. For example, the current account displayed notable changes due to the enhanced competitiveness of Indian goods following the economic reform measures. Export growth accelerated as Indian products became cheaper for foreign markets. Import demand, however, remained robust, partly due to liberalization measures that made capital goods essential for industrial growth more accessible. The resultant trade balance improved gradually, indicating a move towards surplus after years of persistent trade deficits. On the capital account, the post-reform strategy led to increased foreign direct investment inflows. Investors were enticed by India's open market policies, reforms, and the promise of high returns in a burgeoning economy. This influx significantly bolstered the capital account, allowing the country to better finance its trade deficits. Consequently, the overall BOP situation returned to a more favorable position. The financial account also showed positive trends during this period. The liberalization policies not only facilitated greater portfolio investment but also helped stabilize domestic financial markets, encouraging profit-seeking foreign investors. Additionally, reserves built up in the financial account cushioned any speculative attacks on rupee, fostering greater stability in the Indian financial markets. A comparative trend of India's current account, capital account, and balance of payment situations during the pre- and post-reform period have been shown with the help of figures 1 to 3. So in figure 1, we can see the trend of India's current accounts, capital accounts, and balance of payment during the pre-reform period. And in figure 2, we see the trend of India's capital accounts and balance of payment during the post-reform period. And in figure 3, we see the trend of India's capital account during the post-reform period. Now, let us discuss the current trends and future implications. In recent years, India's balance of payment has shown resilience despite ongoing external shocks such as global financial crisis and geopolitical tensions. An overall scenario of India's position in global trade and also the BOP situations can be seen from figure 4. So here in figure 4, we can see India's share in all mercantile trades during the year 2019, 2020, 21 and 22. And also we see the India's balance of payment situations in current account, financial account and change in reserves. Okay, these things we can see. So let us discuss the reasons behind India's favorable position in balance of payment in the post-reform period and in the recent years. So India's favorable position in balance of payments in the post-reform period may be attributed to three major factors. First, high earning from invisibles. Data indicates that in the post-reform periods, earning from invisible have significantly increased. It has increased from US dollar 2,898 million in 1993-94 to 13,143 million in 1990-2000 and to 79,269 million in 2010-11 and further to 1,98,236 million in 2022-23. In fact, earnings from invisible exceeds the deficits in trade account in the years 2001 to 2003-4, due to which we can see a surplus in India's current account in those years. Please see figure 3 for this. You will see this in figure 3. Now, in the recent years like 2021-22, earning from invisibles covered approximately 80% of the country's trade deficits. It is to be noted that in India's foreign trade, trade in invisibles or invisible trade encompasses the exchange of services, income and transfers including travel, transportation, insurance, financial services and remittances, unlike the tangible goods which are considered as visible trades. The second factor is the rise in external borrowings. The rise in external commercial borrowing has been significant since the late 1980s, peaking during the 1990s when they constituted over 31.9% of capital inflows, reaching 55.4% in 1998-99. They experienced a decline between 2001 and 2017-18, but surged to US dollar 21,080 million in 2019-20, fluctuating thereafter. The third important factor is the non-resident deposits. Non-resident deposits increased significantly, benefiting from government incentives, with levels reaching US dollar 38,892 million in 2013-14. Despite a net outflow of 2016-17, NRI stabilized at US dollar 10,387 million in 2018-19, declining slightly in subsequent years, but ultimately recovering to US dollar 8,989 million in 2022-23. The fourth factor is the rising foreign investment. The increasing in foreign investment since 1991 is attributed to government incentives aimed at attracting foreign investors. In fact, foreign investment has accounted for over half of total capital inflows in many Indias, including foreign direct investment and portfolio investment. For example, in 2007-8, total foreign investment was 43,326 US dollar million, with 15,893 million in FDI and 27,343 million in portfolio investment. Despite a decline in 2008-9, it surged to 93,653 million in 2020-21, fueled by India's economic reforms. Please note that in the next unit, we shall particularly discuss this topic of foreign investment in detail. Now, we are almost reaching towards conclusion of this unit, and let us discuss the future challenges and opportunities India faces in terms of foreign trade. So, India's foreign trade sector faces a mix of challenges and opportunities as it navigates an evolving global economic landscape. One of the key challenges is global economic uncertainty, driven by geopolitical tensions, trade wars, and recession risk in major economies. These factors could dampen demand for India's exports, particularly in international markets. Additionally, India's heavy dependence on imports, especially for crude oil, electronics, and critical components, continues to strain the trade balance, making the economy vulnerable to external price shocks. Another significant hurdle is the prevalence of non-tariff barriers in developed markets, where stringent quality standards and compliance requirements often restrict Indian exports. Logistics and infrastructure bottlenecks further compound these issues, with inefficient ports, high transportation costs, and delays reducing India's competitiveness in global trade. Currency volatility also poses a persistent challenge, as fluctuations in the rupee's value can impact export profitability and increase the cost of essential imports. Despite these challenges, India has several opportunities to strengthen its foreign trade performance. Diversification of exports into high growth sectors such as pharmaceuticals, electronics, and renewable energy can reduce reliance on traditional commodities. The government's push for free trade agreements with key partners like the EU, UK, and African nations presents a strategic avenue for access to new markets and enhance trade flows. Domestically, initiatives like the Production Linked Incentives (PLI) scheme, we have talked earlier also about this scheme, are boosting manufacturing capabilities, particularly in electronics, textiles, and automobiles, which could enhance India's export competitiveness. The rapid growth of digital trade and e-commerce also offers promising prospects, especially in IT and fintech services, where India already has a strong global presence. Furthermore, the ongoing shift in the global supply chains driven by the China Plus One strategy, that means just looking for another alternative of China, positions India as a potential manufacturing and export hub for multinational corporations seeking alternative production bases. In conclusion, India's foreign trade future hinges on addressing structural challenges such as infrastructure gaps and trade barriers while leveraging policy reforms and global trends. By capitalizing on emerging opportunities and fostering a more resilient trade ecosystem, India can strengthen its position in the global market and achieve sustainable economic growth. So with this, we come to this end of the unit. Thank you. And in the next unit, we shall discuss the trend of FDI and FII in India. Thank you. Happy learning.